Something changed in the market the moment Washington stepped back from hitting Iran's energy infrastructure. Oil didn't just move, it collapsed. Stocks bounced, bond yields eased, the dollar lost ground. That kind of reversal does not happen because traders suddenly became optimistic people. It happens when the system realizes it may have just avoided a much bigger shock, at least for now. And that matters because the real story here was never just whether the United States would strike Iranian power facilities. The bigger story was what a longer Middle East escalation would do to the countries that bankroll America, ensure global trade, and absorb the cost of Washington's strategic choices. One of those countries is Japan. And if you want to understand why this story got dangerous so fast, you have to stop looking only at missiles and start looking at oil, currencies, and US debt. That is where the pressure was starting to build. I'm Sefa, an international relations graduate. Let's examine events not just from the headlines, but from their depths. A lot of people saw the headlines about Trump delaying strikes on Iran's power network and assumed the crisis had cooled. That is too simple. What actually happened is that one layer of pressure eased while another was exposed. Reuters reported that Trump postponed any attack on Iranian power plants for 5 days and pointed to constructive talks. But Iran denied direct talks with Washington, which means the diplomatic picture is still unstable, even as markets grabbed onto the pause like a drowning man grabbing driftwood. That sounds like a temporary de-escalation. It is, but only in one lane. In the background, the crisis had already shown something more important. A military shock in the Gulf can move straight into currency stress in Asia, then into US bond pricing, then into global risk sentiment. That chain is not theoretical anymore. We just watched markets react to the possibility of a wider war, and then reverse when that possibility appeared to narrow. Brent fell almost 11% in a single session after Trump's pause. That is not normal market noise. That is the financial system admitting how much it was pricing in a deeper rupture. Now here is where Japan enters the story in a much more serious way than most headlines suggest. Japan is still the largest foreign holder of US Treasuries. In January, its holdings stood at about $1.225 trillion, the highest since mid-2022, and they had risen in 12 of the previous 13 months. So the simple clickbait line that Japan has already dumped everything is nonsense. It hasn't. The actual story is more dangerous because it is more believable. Japan does not need to dump all its US bonds to become a problem for Washington. It only needs to come under enough pressure that markets start asking whether it might need to sell some of them. Once that question becomes credible, the damage begins before any huge liquidation even happens. And the reason that question became credible is the yen. Japan has been dealing with a currency problem that already looked unstable before this Iran crisis got hotter. Reuters has been reporting for weeks that the yen was hovering near the politically sensitive 160 per dollar level, with Japanese officials warning they were ready to take decisive action against excessive moves. At the same time, policymakers were also admitting the usual problem. G7 support for intervention is harder to secure when the move looks driven by fundamentals, especially strong dollar demand and yield differentials. In plain English, Tokyo can threaten intervention, but it cannot do it comfortably or endlessly. Now add oil to that equation. Japan imports most of its energy, so when the Middle East gets closer to a broader war, the yen is not just dealing with US interest rates and speculative flows anymore. It is also dealing with the real cost of energy imports. Reuters quoted analysts saying the yen is very exposed to oil prices and could readily break 160 on a further oil shock. That is the part most people miss. A Gulf crisis does not just raise energy prices in some abstract global sense. For Japan, it can translate directly into a weaker currency, higher import costs, and more political pressure on the government to act. This is where the danger starts. If Japanese authorities decide they need to support the yen aggressively, they need firepower. Japan has huge foreign exchange reserves, around $1.4 trillion, and Reuters noted that those reserves are mostly held in US treasuries. That does not mean Tokyo suddenly unloads its entire treasury position. That would be reckless and self-defeating. But it does mean the world knows where the ammunition sits. When the yen comes under pressure and energy costs surge, the market immediately understands that one of America's biggest creditors may be forced to think first about domestic stability, not about the optics of supporting the treasury market. That is a strategic problem for Washington, not because Japan becomes an enemy, not because Tokyo wants to punish the United States, but because alliances do not cancel economic reality. If a US confrontation with Iran helps push up oil, weakens the yen, and raises the political cost of inaction in Tokyo, then America's own security posture starts creating stress inside the balance sheet of one of its most important allies. And that is the kind of contradiction markets hate. It means the same alliance network Washington relies on for strategic legitimacy can also become a transmission belt for financial pressure. Most people hear that and immediately jump to one dramatic image: Japan selling treasuries and crashing the dollar. That is too cinematic and, frankly, too lazy. The real mechanism is subtler. Treasury markets do not need a Hollywood-style liquidation to feel stress. They just need uncertainty about future foreign demand, especially at a time when the US already has enormous borrowing needs. If investors start thinking a major foreign holder may have less flexibility, less appetite, or less reason to keep absorbing US debt at the same pace, yields can rise simply because the margin of safety looks thinner. The move begins with repricing, not panic. And that is why the market reaction to Trump's pause mattered so much. The bond market, equity market, oil market, and currency market all signaled the same thing at once. They were not cheering peace. They were backing away from a scenario in which an energy shock, a yen shock, and a treasury risk story could feed each other. The relief trade was really a vote against escalation. It was the market saying, very clearly, do not turn a regional war into a global financing problem. There is another layer here, and it is even more uncomfortable for Washington. Foreign holdings of US treasuries hit an all-time high in late 2025, and Japan's role in that structure has remained critical. That means the United States still benefits enormously from the willingness of foreign governments and investors to store reserves in dollar assets. But the privilege of being the center of the financial system comes with a hidden dependency. If US policy repeatedly injects military risk into the very regions that determine oil prices, shipping security, and reserve behavior, then America is not just projecting power, it is also testing the tolerance of the countries financing its debt. That may sound symbolic. It isn't. Think about the message this sends to every central bank, sovereign fund, and major reserve manager watching from the sidelines. If a Gulf crisis can ricochet into a yen problem, and a yen problem can reopen questions about treasury demand, then reserve management stops being a sleepy technical issue and becomes part of geopolitical risk pricing. In that world, diversification is no longer just about yield. It becomes about trust, flexibility, and exposure to US-driven volatility. That does not mean a mass exit from treasuries tomorrow. It means the strategic reputation of US debt can be chipped away by crises that Washington itself helps intensify. And there is a reason this feels especially dangerous right now. Japan is not in a comfortable position. Reuters reported that the bar for yen intervention is higher because the weakness is tied in part to fundamentals and safe haven dollar demand, not just obvious speculation. At the same time, Japanese officials have still been warning markets they are ready to act. That is a classic sign of constraint. Tokyo wants to stabilize the currency, but it also knows intervention is politically sensitive, internationally complicated, and not guaranteed to work unless the broader pressure eases. So imagine the alternative path. Imagine Trump had not paused. Imagine strikes on Iranian energy infrastructure had gone ahead, the war widened, oil spiked further, Gulf shipping risks worsened, insurance costs rose, and the yen cracked through 160 in ugly fashion. Then the story would not be whether Japan dumped everything. The story would be whether Japanese authorities, under domestic pressure, had to mobilize reserves more aggressively while global investors began front-running the possibility of future treasury sales. That is how a military decision in the Middle East starts altering financial conditions in the United States itself. This is also where the politics get nasty. Trump can present a pause as toughness with restraint. Iran can deny talks and preserve its own posture. Markets can enjoy a brief relief rally, but none of that fixes the underlying vulnerability that was exposed. The United States remains deeply dependent on foreign confidence in its debt. Japan remains deeply vulnerable to imported energy shocks and currency pressure. And the Gulf remains one of the fastest ways to turn a security crisis into a financial one. The pause bought time. It did not remove the trap. That is the larger system starting to crack. Not the dollar collapsing overnight, not Japan suddenly becoming hostile. Something more structural than that. A world in which America's military decisions can directly unsettle the financial ecosystem that helps finance those decisions. A world in which allies are still allies, but under enough pressure that their domestic survival can no longer be separated from Washington's strategic behavior. A world in which debt, energy, and security are no longer separate stories. They are the same story now. And that changes the calculation for everyone. For Tokyo, it means every Middle East escalation now carries a currency dimension. For Washington, it means every regional show of force can produce a bond market consequence at home. For investors, it means the old assumption that US assets sit above geopolitical blowback looks weaker than it used to. And for the rest of the world, it is another reminder that when the system gets stressed, the real fracture lines are usually hidden in the plumbing, not in the speeches. So what changed here? The United States discovered, again, that escalation against Iran does not stay in the military lane. Japan discovered, again, that a weak yen in an unstable energy environment can turn reserve policy into frontline policy. And markets showed, very clearly, that they understand the connection. The relief after Trump's pause was not confidence. It was fear stepping back from the ledge. Who is under more pressure now? Washington. Because it cannot pretend the cost of confrontation ends at the battlefield. Tokyo. Because it may have to defend domestic stability while sitting on the balance sheet the world watches most closely. Who gained leverage? Not necessarily any single country. The thing that gained leverage was interdependence itself. Oil has leverage. The yen has leverage. Treasury demand has leverage. And that means every future move in this crisis will be judged not just by what it destroys, but by what it destabilizes next. That is the real warning in this story. America does not need a formal break with Japan to feel pain. It only needs its allies to become more constrained, more cautious, and more exposed to shocks created by US strategy. Once that happens, power starts getting more expensive to use. And when power gets more expensive to use, even the strongest country in the system starts losing room to move. If you want more analysis that follows the pressure underneath the headline, this is Sefa in brief.